Jobs report basically in line with expectations. Upward revision on February, however, and a slight increase in wages. What has that said to you about the economy and about what the Fed's path forward could likely be?
Right. So overall, I think we're still seeing some decent momentum in the economy. We saw that with another pretty solid number in terms of overall payroll growth. But I think we're seeing some encouraging signs for at least keeping some hope alive for the soft landing, in that we saw average hourly earnings on trend. It's decelerating. And a big part of that is we're starting to see the labor market come back into balance, not just from weaker demand, but also from greater supply. So we saw the labor force participation rate move up for the fourth straight month. So I think that was an encouraging sign in the report.
So, Robert, same question for you. What did you make out of that jobs report? Basically in line, but again, that revision up to the upside for February.
Yeah, well, thank you, Frank. I think there were two really important takeaways for investors in the job number. The first was for bond investors, the fact that job gains have been slowing. That brings us closer to that ever elusive pause from the Fed. We've all been waiting for that. I think that will alleviate some of the pressure that markets have seen. We've seen a lot of volatility in the bond market. Some of that is because we're coming towards the end of that rate hike cycle. And as soon as we get the Fed to pause, I think some of that rate volatility will ease. You'll see improvements to valuations. For equity investors, the fact that job gains continue to be steady is helpful. It extends the runway on economic expansion. And while we will be dealing with some drag from credit lending due to the Silicon Valley Bank issue and other issues in the banking sector, we think that we will just avoid recession. And one of the reasons is these continued steady gains in the job market. So something for everyone in the last jobs report, but mostly slow and steady.
All right, Robert, I want to stay with you for a minute. Obviously, coming up this week, we have CPI on Wednesday, PPI on Thursday. Both will give us fresh reads on inflation, then big bank earnings on Friday. How would you suggest that investors position ahead of these three very big reports? I know you believe we're leaning towards a pause, but obviously these reports will have a big influence on the Fed going forward.
Yeah, it is a very challenging time here in the short term with a lot of important data. And I think as we've seen in past weeks, each data point tends to create a lot of volatility. So my expectation is for choppy markets in the short term here with a lot of volatility. But I think for investors who have a longer time horizon looking out towards the end of the year, or at least out towards the end of the summer, I think we'll get some relief on the rate front. I think we'll get some relief on valuation, and I think we'll see the economy and earnings hanging in there. So my advice is to be cautious in the short term, but optimistic over the longer term.
All right, so a lot of optimism on your part, Robert. Sarah, I want to come back over to you. Robert said there was something in this jobs report for just about everybody. What about the people that are forecasting a recession? Did you see some data points in there that would lead you to believe that we're moving closer to a recession, or are we basically in the same place we were before this jobs report?
Well, I think we are seeing signs that overall the labor market is weakening. So we've seen a pretty marked downshift in job growth. So if you look at the prior 12 months, we were adding 360,000 jobs per month. Now we're adding 236. So that was the lowest increase we had seen in more than 2 years. And so I think we're certainly seeing that loss of momentum. And right now it's a controlled descent, but that doesn't mean that it's going to stay that way. We're still coming in for some sort of landing. And I think we are seeing some other broader signs of weakness. So temporary employment continuing to trend down. We saw the average work week tick down, so suggesting that employers are using workers less intensely. So I think we're still seeing that loss of momentum. So it doesn't mean we are out of the woods in terms of a potential hard landing by any means.
All right, so but you're saying it's a controlled descent, but doesn't a controlled descent kind of imply that we're headed towards a soft landing as opposed to a crash landing, which would be a recession?
Well, for now, but I think there's still a lot unknown in that context. So I think if you look at some of the other economic activity indicators that we saw last week, they're pointing towards the fact that the economy is beginning to lose quite a bit of momentum, not just within the jobs market. So while I think overall these jobs numbers remain pretty respectable, it's a matter of, can we keep that pace going forward? And our view is, just given the broader deterioration in demand, everything we're seeing from job openings and postings coming down, the NFIB hiring plans, the lowest it's been since 2017, barring the throes of COVID. And now what's a pretty clear uptrend in claims is that labor market is losing pretty significant momentum. So remains to be seen if we can kind of glide down to a more trend-like pace of job growth, or if job growth is going to slow more markedly and potentially drive us into a recession.
So, Robert, I'm going to give you the last word. Again, so many potential market movers coming up: CPI, PPI, big bank earnings. Right now, how are you balancing portfolios? Are you taking some money out of the market, or do you believe the place you want to be right now is equities?
Well, we've had a posture that's just above midpoint of risk for equity exposure, and that's on the basis that earnings and the economy will continue right around the flat line, perhaps slightly positive. And over the course of coming quarters, we'll get improvement in inflation, and that will provide a bit of a boost to valuations. So we do think that this rate hike cycle is really critical here. So once we get to that Fed rate hike pause, we do think valuations will improve a bit, and we think the economy and earnings hang in with slightly positive gains on the basis of the year right around the flat line.